Let's get into our results service now and talk about the retail sector of the JSE Securities Exchange, where Massmart's numbers have come out. Massmart is the second biggest distributor of consumer goods in Africa, and it's a leader in general merchandise, booze and home improvements, etc. Sales were up nearly 15% over the 26 weeks to the 23rd of December of 2012, but it gets a little bit worse after that. Operating profit down about 18%, headline earnings down 21%, but if you take out the costs associated with Walmart, I think both of those numbers would be around about plus 6%, but still not that fantastic. In the studio, the Power Lunch studio in Johannesburg, is Grant Pattison, who is the CEO of Massmart. Grant, is that a little bit harsh on you?
No, I think that's entirely fair. You're right to make the corrections for the transaction costs, but underlying profits grew at 6.1% off sales growth of 15%. And certainly we would say a good result is when profits grow at least as high as sales, and a great result is when it exceeds sales. So we would call it ourselves an average set of results.
Are these costs out the way now, the costs that you alluded to with the transaction?
No question. So there won't be any more transaction costs flowing through the company. The costs related to acquisition are now in the base, so we won't be referring to them anymore. Probably the only underlying cost drag still facing Massmart this year will be the costs of our large investments into supply chain and food retail. I think that will mean that margins will likely remain static for 2013, as long as the economy performs reasonably well, and thereafter 2014 into the future we'll see margin expansion again.
As long as the economy performs reasonably well. Well, that's a big if. But let's get down to why these numbers are relatively anemic. Was there a big effect on your business because of the industrial action that we experienced across the whole economy last year?
Yes, it's hard to draw an exact connection between the two, but what we saw is in November a general slowdown. Christmas, as always, South Africans spent wildly, and certainly use credit to do that, but the same trends from November went through into January and are continuing through February. So I think it's fair to call a link between the two things. I think it's an economic link, not just a link to the lost wages, and hopefully that'll come out in the next few months.
You saw the budget yesterday and there was a toning down of the GDP prospects for South Africa. Does that concern you?
It does. We need around about a 3% GDP growth to maintain net margin. Once it drops below that, it puts pressure on us because, of course, there's underlying cost inflation in our business, electricity, water, lights, rates, labor, that are above inflation, and therefore we do need a GDP growth above 3%.
Yeah, talking about costs and inflation, I think you indicated an inflation of around about 3.5% across the board, which is much lower than the CPI inflation that we're given to believe is between sort of 5.5%, 6% once the new weighting settles down. What is the trend, though? The trend seems to be, from what I hear anecdotally, that 3.5% or whatever the figure was is going to increase.
Yes, I think so. Last year we saw food retail inflation go from negative to around 6 or 7%, maybe peak at 8%. We see it slightly on the way down now. General merchandise, hard good inflation has actually been negative for 5 years. You know, consumers don't often notice prices going down, but actually prices have been going down for the last 5 years. But that's changed slightly now, and we're getting a little bit of inflation in general merchandise. What it points to, though, is for CPI to be at 5.7 or 6%, where product inflation is so low, really points to incredibly high service cost inflation. We know that's in rates and taxes, energy, water, and the like.
Grant, operationally, what about the various divisions, mass discounters, mass build, mass cash, mass warehouse? Any ones that really stand out either positively or negatively over this 26-week period?
Yes, the standout performance was Mass Build. So that's the brand consumers will know as Builders Warehouse and Builders Express and Builders Trade Depot. I mean, I think the housing market has been relatively flat, but that business has performed phenomenally and has grown profits way ahead of sales, and sales grew way ahead of what you'd expect the market to be growing at. So that's our standout good performance. Our standout bad performance was Mass Discounters. That has three businesses in it: Game South Africa, Game Africa, and Dion Wired. Game Africa and Dion Wired performed very well. Sales, profit growth ahead of sales growth in both instances, and very good sales growth. But Game South Africa struggled. I think it's a bit of perhaps 50% own goals and 50% the consumer, that middle income consumer, is under pressure.
Do you worry about, apart from the GDP prospects, which were highlighted by the Minister yesterday during his budget speech, do you also worry about the ongoing argument about unsecured lending being reined in? And have you analysed how much of an impact that does have on your business?
Yes, we provide some unsecured credit products through our stores, mostly through an outsourced partner. So it doesn't directly affect our income statement in terms of bad debts. But of course, we're exposed to the sales effect of credit. Our business in the long term is better off with low and manageable levels of unsecured credit in the consumer business, because of course those high interest costs dig into disposable income. So, I certainly would prefer to see unsecured lending under control and at lower levels, and that consumers, being a bit more patient, waiting to buy something for cash than running out and funding it on short-term credit.